Hello everyone. Uh, Welcome to the Bootcamp. This is CA Sahil Parekh. I would like to first give you a little brief about Bombay Chartered Accountant Society. To all you young students and trainees. So, I was just giving a little brief about Bombay Chartered Accountant Society. It's one of the oldest professional body in our fraternity, a very uh, promising platform for all you young CAs attending this session. Would like to tell you that Bombay Chartered Accountant Society, especially the Human Resource Development Committee, we are doing really a wonderful job in bringing the students together right from their internship days to get them accustomed to the professional fraternity. The boot camp itself is a very good initiative whereby the trainees themselves get a taste of how to present themselves, how to share knowledge, gain knowledge, just as we professionals keep doing it on a regular basis to keep our professional knowledge and skills abreast. Bombay Chartered Accountant Society has always given initiatives and platform to our students to come forth, share their skills, gain from the immense platform that BCAS brings on its bring to all of them. Bootcamp is one of a very niche initiative which BCS has been doing for some time, which gives benefit to bigger firms where their interns can physically attend these sessions. At the same time, a bigger audience uh, of all you students who can join remotely from wherever you all are. So I encourage everybody to come forth and kind of participate in all BCS initiatives, uh, right from skill development, taking participation in volunteering, and even its other initiatives that we keep on taking for all the students. And this is just one of them. And I would encourage more and more such sessions to be conducted. Thanks to BCS, this time the initiative of bootcamp has been held uh, at ASDT and Co, and we are thankful to them as well. I would let CA Aditya, the faculty and mentor, and his colleague Shravani Erram to now take forward the today's topic. Uh, and thank you everyone for listening to me patiently. But look forward to see you more and more at BCS next learning sessions for youngsters and start students. Aditya, over to you.
So thank you so much, Sahil. Thank you so much, Sahil, for the introduction. And firstly, I like to thank the BCS for such a wonderful initiative. The students are our future professionals, and it's a very good initiative by BCS to connect and to train the future chartered accountants from their articleship days as well. So, firstly, thank you so much for BCAS, and thank you, Sahil, and all the partners for inviting us in your beautiful, lovely office. Thank you to the team for joining us for a physical session. So, and thank you everyone for joining in from all around India, hopefully. So, uh, I'll start. I will start with our session. I'll give you a brief introduction. Income Tax Act 2025. Now, as everyone is an articleship student, I know how vast the Income Tax Act 1961 is, and uh, the finance minister has promised that you are going to simplify it. Hopefully, it is, and we are going to try to present it as much as possible. But you would understand that a topic as vast as Income Tax Act 2025, not everything can be covered in just 2 hours. So what we have tried to do over here, looking at the audience being students majorly, we are not going to deep dive into too much of litigation issues or issues that can create a lot of litigations. But what our objective for the session and what Shravani is going to try today to do or deliver over here is that after these 2 hours, for all the participants who are here with us, physical, online, at least they have a path to navigate the Income Tax Act, the new Income Tax Act. Now, I don't know how much of you have already looked into the new act or how much of you have read through the new act. But at least if we can give you a starting point over here, that okay, where is salary? Where does salary section come from? Where does income, house property comes from? Where is business and profession coming from? Maybe we cannot cover all the sections. It's impossible to do it. But at least if we can give you an overview that how do you start? How do we navigate? ICA has made a wonderful comparative chart of the old sections and the new sections. We will present the screen. Shravani will present the screen. She will show you the act. Actually, we will together navigate a few sections together so that at least you get an overview that how the new act is prepared. So before I actually hand it over to Shravani, when the act or the budget in the bill was passed, they said that the finance minister said that there were three guiding principles based on which the Income Tax Act was prepared. The first one was textual and structural simplification. In that, what they have tried to achieve over here is that they have tried to simplify the language as much as possible. Now, when you say that we are going to simplify the language, it means that you are going to change the words, change the structuring of the language. And since you're all article students, you must have seen case laws, you must have read case laws. Even a small change of word can lead to a different meaning. So, despite having the best of the intentions, a lot of tax professionals are arguing that despite of the best intentions, there are so many places wherein the meaning seems to have changed. And because of that, mostly what's going to happen in the next 3 4 years, a lot of amendments might be expected because there were so many concepts based on just one single word. There were just so many there was a case law just on interpreting a semicolon, how and where it is put. So and now when we have changed all of this, there would be the meaning would change. The very important thing, obviously Shravani will cover that, is provisos and explanations are removed. Now provisos, as you might know, are always with the section, are interpreted with the section, but they have also removed and they have introduced as subsections. So uh, there it is going to be a bit difficult to just simplify without me changing any meaning of it. And as you know, the courts are going to interpret what is written and not the intentions. The guidelines might say, the second guideline might say no major tax policy changes to ensure continuity and certainty. However, despite this being a guideline, this is just a guideline, not the act. So then at the end of the day, the courts is going to interpret what's there in the law. And if the law is in a certain way, then it is in a certain way. Then the third one was no modification in the tax rates. Yes, that is kept in the word. So that's a good thing. This has preserved a predictability for the taxpayers. So with that, I won't take a lot of your time. I will hand it over to Shravani, who is our group leader, the speaker for today. And I'll hand it over to Shravani right now, and we'll start the session.
It is truly an honor to sit in a room with such aspiring people, and I'm truly grateful to BCS and to Mr. Aditya Pradhan to give me this opportunity to present in front of you. my point of view and my learning on the new Income Tax Act 2025. On this sweet note, we shall start with the Income Tax Act 2025. When we hear the term Income Tax Act 2025, the first reaction is not an excitement, it is an uncertainty. Because we have learned Income Tax Act 1961 our whole life. And it is complicated and it is difficult for us to adapt from that and to relearn the act in 2025. For years, we have studied and practiced the Income Tax Act 1961. We know the sections, the structures, and the usual problem areas. The new act changes that comfort zone. We have the new Income Tax Act changes the comfort zone with the new numbering, the new language, and the fresh framework. Since the law is still new and unattested, there is no settled interpretation or of judicial guidance yet. With this understanding and practice, we have it will take time for us to gradually learn the act. Today, we will focus on why the law was rewritten, has really changed, and how it will affect us while filing the ITRs. With that context, let us begin why the government felt the need to replace a 60-year-old law. As chartered accountant articles, all of us has grown academically with the Income Tax Act 1961. For more than 6 decades, it has formed the backbone of direct taxation in India. So the natural question that arises, if the law functioned over for 60 years, why was there a need to replace it? The answer is not that the old law failed, rather the manner in which the law was drafted and continuously amended over the time made it increasingly suitable for today's economy, technology, and compliance environment. To understand the rationale between the Income Tax Act and the 2025 Act, Income Tax Act 1961 and the 2025 Act, we will first have to understand what went wrong with the 1961 Act. In this session, I'm going to cover why there was a need to start a new act. In this session, we'll know I'm going to divide the timeline between in why there was a need to start a new act and what are the structural changes in the new act. And we all know there's a terminology for tax year which has been introduced. I'm going to speak on that. The key provisions and comparative changes in heads of income. I'm going to speak on that. And there's also TDS, TCS provisions. And there are other concepts which I have to just discuss, which are new to the Act. So, firstly, we'll note the problems that were in the old Act. So, as you know, the Act is 6 decades ago. So, whenever there are amendments, they wouldn't just reverse the main section, they'll put a provisos in it. So it will make the act more big and it is more complicated for us to understand it. So the first, excessive amendments and loss of coherence. 1961 Act was amended almost every year through the Finance Acts. Over time, this led to a law that was bulky, fragmented, and difficult to follow. Sections were inserted, substituted, and provisos added. And the explanations were layered fragmentedly, in resulting in a statute that lacked the logical flow and legislative clarity. So when we get to the last explanation, we'll forget about the main section. I'm going to give an example of section 80D, which so in 80C, sorry, there are many provisions added which made the main law irrelevant. So in the new act, as we know, the law has been rewritten. So they have added just the main section is the main content. Second is the complex and the technical drafting. The language of 1961 Act became highly technical and legalistic, making it difficult for the taxpayers, especially for the individuals and small businesses, to understand their tax obligations without professional assistance. Making multiple cross referencing and long provisos within the sections increased interpretational confusion. As we know, laymen cannot understand Income Tax Act 1961. They'll get more confused. And that was one problem. Then there was litigation due to ambiguity and interpretational disputes. It was vague, there was vague language, overlapping provisions, inconsistent drafting, resulting in extensive litigation. Courts were frequently required to interpret intent, which led to uncertainty and prolonged disputes between the taxpayers and the tax authorities. So, what I mean by saying is it is an unclear law which leads to multiple interpretations, and so every person, such as the taxpayer, will think from his perspective from saving the taxes, and the tax authority will look from a perspective to increase the taxes. So these interpretations are makes confusion and increase the litigation. That's thing. Fourth is the outdated structure not aligned with the modern economy. 1961 Act was framed for a traditional economy and gradually patched to accommodate digital transactions, e-commerce, global income flows, and new business models. This patchwork approach made the law ineffective and unsuitable for technology-driven and globally interpreted economy. What they did, they couldn't try to fit the new concepts in the old act. So today we are in the digital world, but there are no provisions, there are no concepts of that in the old act. Then it is, as I said before, there is a lack of the taxpayer friendly. They can't file their own ITRs. They have to get our helps. The earlier act was often perceived as authority centric rather than taxpayer centric. Compliance provisions, procedures were complex, the forms were numerous, and consequences for non compliance were severe, even for minor defaults, discouraging the voluntary compliance. Next, I'm going to talk about the key features that were introduced in the new Act. So, firstly, the Income Tax Act 2025 was passed by the Indian Parliament and received a presidential assent on 21st August 2025. The act is applicable from 1st April 2026. It replaces the previous legislation, the 1961 Act, thus making the act applicable for us CA students exam wise from May 27. So bad luck for the people who are giving the attempts after May 27.
That's the most important now.
Yeah. The object of the new act is not primarily to increase the tax collection, it is to improve the tax certainty and to give it a clarity and compliance. First, simplification and clarity. The act uses clear, more concise language, reduces redundant provisions, reorganizes the law to make it easier to understand and apply, thereby reducing the ambiguity and disputes. For example, in the 1961 Act, there was a term for notwithstanding with. Layman people cannot know that word, the meaning of that. So they have replaced that with irrespective of the term. Second, structural reform. The Act replaces the traditional previous year term and the assessment year term with a unified tax year concept for simplicity and alignment with global practice. I'm going to explain this further in detail, but the main is your There are a lot of confusion between the previous year and what is our assessment year. So it reduces our technique. Third is taxpayer centric approach. While the core tax rates remain unchanged, there is a stronger focus on transparency, predictability, and reducing litigation. So the normal layman can read the law chronologically because the law is written in a way that it is made chronological. So the charging section is first, and then the deductions and the complex computation of income, and then the deductions and everything. Lastly, contemporary issues. The law explicitly recognizes and modernizes the taxation for virtual. Lastly, contemporary issues. The law explicitly recognizes and modernizes the taxation for virtual digital assets and other emerging incomes. I'm going to talk about the tax year in detail. It is given in Section 3 of the new Act. I'm going to define assessment year and previous year. So in 1961 Act, assessment year was given in Section 2, Clause 9, which means the period of 12 months commencing on the first day of April every year. And the previous year was given in Section 3 of the 1961 Act, which meant the financial year immediately preceding the assessment year. Provided in the case of business or profession newly set up or a source of income newly coming into existence in the said financial year, the previous year shall be the period beginning with the act of the setting up of the business or profession or the date on which the source of income newly comes into existence and ending with the financial year. These two terms that has been removed from the new act, and tax year has been introduced. Tax year is defined in Section 3 of the new Act, which says in 3 Clause 1, for the purpose of this Act, tax year means a 12-month period for the financial year commencing on the first year. 3 Clause 2, in the case of business or profession newly set up or a source of income newly coming into existence in any financial year, the tax year shall be the period beginning with A, Clause A, the date of setting up of such business or profession. Clause B, the date on which such income or source of income newly comes into existence and ending with the said financial year. So earlier income was earned in 1 year, that is the financial year, and it was taxed in the next year, that was the assessment year, which often confused the students and the taxpayers. Now the tax year is a 12-month period from 1st April to 31st March, in which the income is earned as well as taxed in the subsequent year. And, for example, income earned in April 2025 to 31st March 2026 will belong to the tax year 25-26. And the return will be filed in the subsequent year, which is 26-27. The term for that will also be tax year. It will not be assessment, or it will be a subsequent tax year. So,
Okay, I'd like to add something over here. So, in addition, what was happening in last year in the previous act was a very peculiar confusion between interpreting a date of amendments. Now, for example, let's say I do an amendment in section 54, adding something, and I write this amendment takes effect from 1st April 2025. Now, and let's say there is another amendment in a TDS provision wherein the rate of TDS is changed. And I say that the amendment takes place from 1st of April 2026, 2025 in our same example. 1st April 2025 is remaining the same for everyone. Correct? But now, if there is a change in section 54, then what happens is this is an amendment in the law. This is an amendment in the law. So, this 1st April 2025 is construed as a assessment year because our entire Income Tax Act runs on an assessment year basis. So, that's why what happens is this amendment in section 54, which is from 1st April 2025, is for AY 25-26. So any transaction which you do from 1st April 24, it will be applicable. However, for any amendment which is mechanical in nature, for them 1st April 25 means the date 1st April. So the TDS rate deduction changes from 1st April 25. Now, I think all this confusion should be rested down. When you say that this amendment will be applicable from the tax year 25-26, it's for final. It's for that year. The TDS rate changes from 1st October or 1st April 25-28. It is prospective. No assessment, financial year, and all those things. So this is a very welcome provision. And there was a lot of confusion. Even drafting papers, even drafting submissions. We start with financial year. And somewhere we write assessment year, somewhere we write previous year, somewhere we write year, somewhere we forget to write anything. So a lot of confusion. Now 25-26 is 25-20.
Thank you, sir. Next, I would like to discuss Section 5 of Income Tax Act 2025 and 1961. So there, it is about the scope of the total income. I'll first read out this section and then I'll tell the differences between them. Income Tax Act 2025, Clause 8, Clause 1. Subject to the provisions of this Act, the total income of any tax year of a person who is a resident includes all the income from whatever source derived, which, Clause A, is received or deemed to be received in India in that year by or on behalf of such person. Clause B, accrues or arises or deemed to accrue or arise to such person in India in that year, or Clause C, accrues or arises to such person outside India in that year. But when such a person is not ordinary resident in India, under Section 6, Clause 13, such income shall be included only when it is derived from a business controlled or a profession set up in India. The key difference between them, as you can see in 1961, Clause A, the end is there's an or included. But in 2025, they have removed the or. So it creates a confusion as to whether A is compulsorily applicable or it is optional. The three are optional. Also, I would like to say that the semicolon is included. That means the section is cumulative. So all three are cumulative. Third, I would like to say is in clause C, there's a comma but. So as I've searched on Google, is when we put comma but, the it makes two separate sentences. So accrues or arises to such person outside India in that year becomes one sentence, and the other part becomes completely a new sentence. But if we look at that from that perspective, so a non-ordinary person shall not be taxed for his income in India, or if he arises income in, or it accrues in income in India, or if he accrues in outside India. So there's a confusion between that.
Can I add something? I'll just add something to what Shravani just said. So what this confusion mainly is that if you see the last C clause, accrues or arise to such person outside India in that year, and then they put a comma and they say but. Now this is a very interpretational issue, and many as a students you might not even agree with it, but uh, and I don't know if anyone will even challenge on this, but any person, if this is getting very useful for me, we might even challenge that. So what is the confusion is, I'll just add to what Shravani just said. When you put a comma and you say but, then that sentence becomes an independent sentence. So what does C says? A cruiser arrives to such person outside India in that year. So we are talking about foreign income, correct? Clause C is talking about foreign income. And after comma and but it is saying comma but when such person is not ordinary resident. So he's a resident but not ordinary resident. For not ordinary resident, in common parlance, foreign income is not taxable. This is the common. But then as an interpretational thing, issue or maybe a challenge, you can say, a stand may be taken that this is completely an independent statement. So, if you are a not ordinary resident, then even A and B will not be applicable to you. So, I know these are all very interpretational thing, and I started with my presentation with this. English is a language wherein interpretation is very different. So, a small comma, a small but, all those things has a lot of huge interpretational issues. So that's what we are trying to convey, and the or which is missing in first A and B. I happened to be in one of a seminar wherein very learned professionals were there, very senior professionals, and they were arguing on this for 50 minutes that what are the consequences of this or not being there and how maybe advantage can be taken of it. Will not dwell so much into it, but yeah, that is again an issue. So in a zeal of oversimplification of things, such things are happening. So that's why I was saying that amendments are very much possible. Please.
Next, like to tell about the residents of India, which is given in section 6. There's a difference. There's a change in the new act. So I'll first read the section. Section 6, Clause 1. For the purpose of this act, residential status in India in a tax year of a person shall be determined as per the provisions of this section. Section 6, Clause 2. An individual shall be resident in India in a tax year if he, Clause A, is in India for a total period of 182 days or more in that year, tax year, or B, is he in India cumulative for 60 days or more during that year, and he has been in India cumulative for 365 days in the last preceding 4 years. It was in the old act also. The difference between is, as you can see in clause 2, subsection 2, clause A, they have given is he in India for a total period of 182 days. So there can be a interpretation or they can take advantage from it because it says for a total period of 182 days. So you have to be continuously for 182 days in India, then only you will be a resident. So if you come for part 30 days, you won't be a resident. I can interpret from that as well.
There is a Supreme Court judgment regarding that. When we were discussing this, there is a Supreme Court judgment which says that the period wherein it was the word period was defined by Supreme Court. And it means that a fixed length of time which is uninterrupted. So in the previous act, it is so beautifully written, a period or periods amounting to all. Over here, period. Again, interpretational challenge. So, yes.
Next, there's a small difference in the relative definition as well. In the Act 2025, in section 2 of section 2 subsection 94, relative means or relative in relation to an individual means a husband, wife, brother, sister, or any lineal ascendant, maternal as well as paternal, or descendant of that individual. There's always been a confusion, and we every time we do ITRs, we have to check the definition of relative, and so this clears the thing in the new act. Next, I would like to say the structural and the drafting changes which has been taken in the new Act 2025.
Shravani, if you're okay, I'll just say something on the relative part. Yes. So I just give you a context of what it was. Hindu Succession Act. There was in the definition of lineal ascendant somewhere it says that maternal side in lineal ascendants are not common. So some uh, zealous income tax officers said since lineal ascendant is not defined in Income Tax Act, we'll go with Hindu Succession. And the Hindu Succession Act says that maternal side lineal ascendants should not be there. So if you receive a gift from your Nana, no, that is that. That so now they have said that no. In relative, it should be maternal and paternal. Relative is defined 4 times in Income Tax Act. Section 2 is there. Section 13 is there for charitable purposes. Section 42B, then section 56. And courts have said that all the relatives will be for that respective section, it will be applicable. So this was all. Now they are saying now no, paternal both. Confusion has been lessened. So these are all welcome changes. When they are saying a simplification, they are doing very good things. So this is a very welcome change.
Next, we'll learn about the structural and the drafting changes which has been taken in Act 2025. Firstly, the shift from the amendment based law to a clean slate approach. As I said before, the section they have not revised the main section, they have just added the provisos and everything. So in the new act, it has been rewritten, so they have there's a clean slate approach. So there's only one main section which covers everything. You don't have to go explanation wise. So, the Income Tax Act 1961 evolved through a continuous patchwork amendments. Every year, instead of rewriting the provisions, the legislature kept on inserting provisos, explanations, exceptions, and retrospective clarifications. As a result, many sections became layered and fragmented. The Income Tax Act 2025 adopts a clean slate approach. Instead of carrying the forward old drafting baggage, the provisions are rewritten afresh. The redundant language has been removed and the overlapping concepts are consolidated. This means the law is no longer a collection of historical amendments. It is a coherent, integrated code. Second, logical reorganization of chapters and provisions. The new act has been logically restructured, grouping related provisions together. This makes it easier to locate the sections during the return filing, assessments, and while preparing the replies to the notices, instead of jumping across multiple sections as we did in the old act. An example on this is there was one section is for charge, one section is for computation, one chapter is for procedures. It requires constant cross referencing. 2025 Act does that. They have made all the charging, computation, and procedure logically and sequential. So they'll be in sequential order. You don't have to jump around. The reader can understand the issue from start to end in one flow. Major change. In the old act there were 47 chapters, and in the new act they have reduced to 23 chapters. And as per sections, there were previous 819 sections. I know there are originally only 298, but they have added the some like 47, 80C, 80D, CCD. They have combined everything, thus the 819 sections. And in the new law, it has been reduced to 536 sections. Third, simplification of drafting language. Under the 1961 Act, many provisions were written as a single long sentences, whereas the 2025 Act breaks the provisions into clear clauses and uses the numbered conditions or structured paragraphs. There is also a major change that the words have been numbered. The number of words have been reduced in the new Act. Previous it was 5 lakh and 12,000 words. Now it is 2 lakh and 60,000 words. Instead of one paragraph covering the eligibility, the exceptions, the limits, the conditions, the new act separated them into distinct clauses, making the compliance much cleaner. Also, wherein the provisos earlier often changed the main rule completely, the new act has made fewer provisos, and the exceptions are placed within the main proviso itself. Thus, we can say the law is no longer hides the exceptions at the end. If there is a condition, you see it immediately after reading the section. It resolves the interpretational disputes. Fourth is they have in the new act there's a major change that they have instead of giving long paragraphs for the sections, they have used tables and formulas and structured formats for the act. So you will we understand visual perspective more clearly. So they have done that. So in the new act, there are 57 tables and the formulas are 46. There's a concrete evidence that the drafting now visually guides the professionals in computation and thresholds. Yeah, because of this, the reading of the statute gives a complete picture. The literal interpretation becomes meaningful, and the case laws act as a support and not as a starting point. Then I'll move on to the third part of of my agenda, which is the heads of income. So in the new act, the heads of income are defined in section 13, whereas in the old act it was in section 14. There is no change in the definition. I'll move on to the first head, which is income from salary. In the new act, they have given separate sections for perquisites and profits in lieu of salary, wherein in the old act it was combined in section 17. So section 15 will be for charging of the salaries. Section 16 will be income from salaries. It will define the incomes which will be head in the salaries section. Then section 17 will be for perquisites. Section 18 is for profits in lieu of salary. And section 19 is for deductions from salary. So, under the Income Tax Act 2025, as amended by the Taxation Laws Amendment Bill 2025, the salary income computation explicitly incorporates a standard deduction under the section 16. There are few changes in the income from salary. So, firstly, I would like to say is in the definition of salaries, they have mentioned employer or former employer. In the new act, they have given a separate subsection which says that employer includes a former employer. I'll show you. One second. So this is a PDF which the income tax has given. It is a tabular mapping of the 2025 Act and the 1961 Act. See, you're in salaries. The this side is the new Act sections, and this side is the old Act sections. So as we can see in section 15, subsection 2, it specifically says that for the purpose of subsection 1, employer includes former employer. Whereas in the previous act, it was in the subsection 1, it was employee, any salary due from an employer or former employer. Second is advance salary. So advance salary is, as we all know, it is taxed when we have received the salary. And in the old act, it says in explanation 1 that advance salary will not be taxed when it actually becomes due, which has been in the new act given in section subclause 3. If any salary paid in advance is included in the total income of any person in any tax year, it shall not be included again in the total income of such person when the salary actually becomes due. Third is about the partner's income, which is also given in subclause 4, that any salary, bonus, commission, or remuneration by whatever name called due to or received by or partner of firm from the firm shall not be regarded as a salary for the purpose of this section. In old act, it was given in explanation 2. It was later amended and it was given in explanation 2. Then the perquisites. Um, perquisites are exempted, and perquisites is included in section 17.
Actually, so something got missed in the, or I think got deleted in the PPT. You can go ahead and skip the perquisite point. Go ahead with the new deduction section.
So the deductions of the income from salary are given in section 19, which is 75,000 rupees as standard deduction. And in addition, under section 87A as amended, which is rebate of 60,000 rupees for the individual taxpayers, which effectively makes taxable income up to 12 lakh rupees tax free before the rebate application.
So this is how they have actually simplified the act or the law. If you are sharing, right? It's on the full share.
Yeah.
Yeah. So now, Aditya, Shravani just shared with you section 15, wherein we saw how they have come in, how they have put in the subsections. See over here now, this subsection, this one. If any salary paid in advance is included in the total income, what it actually means is, let's say April month salary, you get it in March. So it is taxable in March. So March being the previous year, it will be taxed in that year. So in next year, when it's actually due, should not be taxed. That's the basic thing. The most important thing that we understand from here that how they have structurally changed it now. See, from over here, it's a new subsection. Now, if we go to uh, Income Tax Act, the old Income Tax Act, Income Tax Act 1961, this one is the same section 50. Yeah, it's the same section 15, correct? Now just see how they have changed it. Same section 15. Over there, it was as an explanation 1. So this is how they have done it. All the explanations, all the provisos are now subsections. Over here it was anymore. It was clearly declared that the salary paid in advance, including total income, it shall not be included again in the total income when it becomes due. And now over here, they have made it into another subsection. So that is how they have changed the act. This is what we are trying to bring out over here.
So, as we all know, the standard deduction in the new act has been 75,000. It is in the Finance Act 2025, so there's no major change. Income from salary, there is no major change as per se. And I'll talk about the allowances and exemptions from under the salary. Under the new tax regime, most traditional exemptions from salary allowances are not available if the taxpayer opts for a new regime. And this is a major departure from the earlier Act's practice, where specific allowances had separate exemption conditions. The most significant changes in this regard is HRA, which is the house rent allowance, is not will not be available as deduction under the new regime. Tax concessions will not be available under the new regime, and entertainment allowance will also be not available in the new regime. And other allowances under Section 10 not available in the new regime except where specifically preserved. However, under both old and new regime, certain infrequently claimed allowances and reliefs continue to exist, which is transport allowance, conveyance for duties, and travel and daily allowances.
Since we are on the chapter of salary, Shravani, maybe you want to show them the rates also. It's there ahead or it's ahead, no? Okay, so please continue.
I'll speak about the employer contribution as well. Under the computation rules, which integrate Section 17 and related provisions, so employer contribution to NPS, which is the National Pension System, remains deductible up to a ceiling limit of 14% of the salary of the employee. There's no major change as per se in the heads of income. It's just that the act has been made clearer and the sections have been remodeled. Now we can see here is firstly in 1961 it was under section gratuity was under section 10 sub clause 10, pension was under section 10 subsection 10a, leave salary was under section 10 subsection 10aa. Now it all has been clubbed under section 19. I'll show. So they have also made it easier by making a table of all the deductions from salaries, which is says the standard deduction 75% of the salary, whichever is less, where the income tax is computed under section 202 clause or subsection 1, which was under the old act, which is 115 BAC, which is the new regime act. Next, I'll move forward to income from house property. In the new act, they have separated the sections from section 20, which is the charging section. Section 21 is the determination of the annual value. Section 22 is the deductions from the income from the house property. Section 23 is the arrears of rent and unrealized rent received subsequently. Section 24 is the property owned by co-owners, and Section 25 is the interpretation of the whole from Section 20 to 24. They have interpreted it in one section. So you'll have to just go through that if there's any confusion. So under the Income Tax Act 2025, the head how income from house property continues to be a distinct head of income for individuals and other taxpayers who own residential or commercial properties that are not used in their business or profession. The new act consolidates and clarifies the computation rules so that the taxpayers can determine the taxable income from property more transparently. The overall structure follows the same pattern under the old Act 1961, and ordering of the computation remains aligned. with in existing practice, thereby ensuring consistency and with well settled principles. Under Section 21, it is the uh, determination of the annual value. So, Section 21 defines for the purpose of Section 20, which is the charging section, that of annual value of any property shall be deemed to be the higher of the following. Subclause A, the sum for which it might reasonably be expected to let from year to year, or the actual rent received or receivable by the owner if the property or any part of it is let out. Second, it specific in section 22, it specifically says that the municipal taxes will be deductive, and then the 30% rate will be applicable, will be deducted, the 30% deduction. Further, house owners can claim deductions from interest paid on the borrowed capital used for acquisition, construction, repair, renewal, or reconstruction of the property. The Act provides for two components. One is the interest payable on loan taken for property financing, and second is the loan interest on capital borrowed during the peak pre-construction period, which can be claimed in 5 equal installments over 5 tax years, beginning with the year in which the construction completed. The Lok Sabha Select Committee clarified that the pre-construction interest deduction is available to both self-occupied and let-out properties, restoring the parity with the existing law and aligned with the new act with established practice.
So when the act was actually built, so there was this confusion that whether this interest will be allowed or not. So it was when it was the first bill came into place, it was given to a parliamentary selection committee, right? So and that's after that the parliamentary selection committee gave a report with almost 4,500 changes. The majority of them were taken into the bill, and then it was passed. So this was one of the
So the interest limits for let-out property, we can fully deduct the interest amount. And for self-occupied property, there's a limit of 2 lakh rupees. If we acquire the property and if we reconstruct the property, it is 30,000 rupees. Together, you can only claim up to a 2 lakh rupees. That's the limit. It was in the old act as well. Next, we'll go to income from capital gain. The sections have been redefined, and it has like in 1961 section 45, now it is given in section 67, the charging section of the capital gains. The subsections, provisions, and the explanations have been removed and replaced with the separate clauses. So you'll see in section 67, in the old act it was there were sub clauses. Here they have mentioned everything in one place, in one section. So there are 18 clauses, 18 subsections which defines the capital gain income. Section 70, which was earlier section 47, transfer not regarded as transfer. All the provisions relating to the amalgamation are grouped first, followed by a demerger, and so on. So in the old act, there was it was given. So in here, the subsection involved that amalgamation was relating. It was a subsection for the amalgamation in relation to a company. Section subclause 7A was relating to amalgamation in relation to shares. Basically, what I want to say is that in the old act, the um, the sections were in separate places. So amalgamation, then there was in 7B, you can see there's demerger of the company. 7, whereas in the new act, the amalgamation provisions are together or given together, that there's amalgamation in relation to company and amalgamation in relation to a shareholder, and then the demerger provision is given. There's also one change is that in the new act, the clauses are lettered, so subclause A, B, C, D, whereas in the old act it was 1, 2, 3, 4. Section 72, which is corresponding to section 48 of the old act, mode of computation of capital gains. It clearly explains the indexation is available only on tax provisions, non-allowability of interest and STT. It is grouped in one section. It is more clearly structured and it follows a better sequence. Section 73, it is corresponding to section 49 of the old act. It was of the cost with reference to certain modes of acquisition. In the new act, it has been tabled, so for clear understanding. So here you can see that it is clearly tabled. Section 77, corresponding to section 50B of the old act, special provision for computation of capital gains in relation to slump sale. It continues to consider the 36-month holding period for the short-term capital gain. In section 72, they have made a not major, but a quite understandable change. They have added a formula in the new act, where in the old act it was given in paragraph form.
There's some typo over here. I think it's not 2nd July. It's 23rd of July, 2024. So, as you might be all aware, that this section was introduced in the second budget of the last year, wherein what had happened was the rate of long-term capital gain tax was changed from 20% to 12.5%, and indexation was removed. So then after the Halla Gulla, they again reverted it back. But now in section 72, it's the same thing, but just by way of formula. So as Shravani was discussing ahead in the start, that there are so many new formulas, right? There were some few formulas were there first, and now there are so many formulas. So this is an example of a formula, okay? It's the same thing. We do the same thing, but they have put it into the act now. So it's their way of trying to make it more simpler.
So I'll read the act, section 72, clause subsection 2. For the purpose of item B of the formula in section 71, clause 2, the expression cost of acquisition and cost of any improvement used in the computation of long-term capital gain shall be read as indexed cost of acquisition and indexed cost of improvement. In the case of transfer of long-term capital asset, being land or building held for more than 24 months before the 23rd of July 2024, or for other long-term capital assets held for more than 12 months before the formula is that the A minus B is equal to C. C is the excess tax which has been ignored. A is the tax which will be calculated at the rate of 12.5%, and B will be the tax which has been calculated at the rate of 20%. So the excess of both the will be ignored. Section 78, clause 1. If a consideration received or accrued for the transfer of capital asset, being land or building or both, is less than the stamp duty value, then for the purpose of section 72, the stamp duty value shall be deemed to be the full value of the consideration received or accruing as a result of such transfer, subject to the following. Clause A. The stamp duty value on the date of agreement may be taken as a full value of consideration if the date of the agreement fixing the consideration and the date of the registration for the transfer of the capital asset are not the same. And clause B, a part of fully consideration is received on or before the date of agreement in specified banking or online mode as defined in section 66, subsection 32. Subsection 2 says that without prejudice to the provisions of subsection 1, the assessing officer may refer to the valuation of the capital asset to the valuation officer, and provisions of section 269, subsection 3 to subsection 8 shall, with necessary modifications, apply in relation to such reference. Where A. The assessee claims that the stamp duty value exceeds the fair market value of the property as on the date of the transfer, and subsection B. The stamp duty value has not been disputed in any appeal of revision, or no reference has been made before any other authority, court, or high court. If the value determined by the valuation officer on a reference made under subsection 2 exceeds the stamp duty value, then the stamp duty value shall be taken as a full value of consideration. Here I have defined a capital asset. Capital asset means property of any kind, whether tangible or intangible, movable or immovable, held by an assessee, whether or not connected with his business or profession. It includes land and building, shares, security, debentures, bonds, mutual fund units. Personal effects are excluded, but jewelry, archaeological collections, and work of arts has been included. Or rights in or in relation to an Indian company or foreign entity. Agricultural land in rural area is excluded, as it was in the old act also. Definition of short-term capital gain is listed equity shares, units of equity oriented mutual funds, or UTI, units of UTI, if they are acquired 12 months or less, that will be, and if they are sold within 12 months or less, they will be under short term capital gain. In case of immovable property, land or building, or unlisted shares, 24 months or less is the holding period. And for other, previously it was 36 months, but it has been amended to 24 months now. Then for long-term capital gain, you can claim it will be taxed at the rate of 12.5% without indexation, or you can opt for 20% with indexation. The exemption threshold of rupees 1,25,000 continues to apply on gains. Only gains exceeding rupees 1,25,000 in a financial year are chargeable to tax. Further, as PGBP, that is the profits and gains of business or profession, is a vast concept, I will not be able to discuss it in detail, section wise. Thus, I'm only providing with the section changes. That is section 20, which is a charging section. Section 21, there's an error in this. Under PGBP, I want to say that under the Income Tax Act 2025, the head income from business or profession continues to operate on a same substantial charging principle as the earlier law. However, the new act introduces several newly structured and system-oriented provisions, the importance of which lies not in changing the tax rates, but in changing how the business income is determined, verified, and administered. The new act brings all the computation related provisions for business and profession under a single integrated chapter, which is structural addition aimed at reducing the interpretational overlap and the compliance errors. Another important newly added aspect is the explicit statutory linkage between the accounting standards, the income computational standards, and the tax computation. While the income computation under disclosure standards existed earlier through delegated legislation, the 2025 Act formally embeds their applicability within the main statute. This ensures that the deviation between the accounting profit and the taxable profit are no longer treated as interpretational issues, but as a statutorily governed adjustments, thereby reducing the litigation. The 2025 Act also introduces distinct compliance classification mechanism for business based on risk profiling. Certain procedural provisions relating to scrutiny selection, verification of expenses, disallowance triggers are now tied to digitally verifiable parameters, such as the modes of transactions, the consistency of the reporting, the system generated mismatches. While the quantum thresholds may be notified separately, the enabling provision itself is newly incorporated in the Act, reflecting a shift towards the data-driven taxation. The presumptive taxation provisions are structured reorganized under the Income Tax Act 2025. Next, I shall go to income from other sources. Under the new Act, Section 92 says about the income from other sources. Section 93 says about deductions. Section 94 says about the amounts which are not deductible. And Section 95 says about the profits chargeable to tax. It is a traditionally misunderstood head. So let us understand it conceptually. Income from other sources is a residual head of income. This means that the income is taxed under this head only when it is not taxable. It is not classified under any of the other four heads, namely salary, house property, business of profession, or capital gains. This fundamental principle remains unchanged under the Income Tax Act 2025. However, the reason this had required restructuring was that under the earlier act, it was frequently used as a default or a dumping head. Whenever classification becomes difficult, income was pushed into the Other Sources Act. So don't know the classification, you don't have any, like it won't be taxable under the four heads, then it is taxable under and other sources. We have that interpretation, but it's wrong, which led to disputes and inconsistent assessments and unnecessary litigation. Under the new act, it specifically addresses this problem. The scope of this head is not expanded, but it is organized and clarified. The law now clearly identifies what types of income belong here and how each type should be taxed. It reduces the discretion and improves the uncertainty. And improves the certainty, sorry. As we can see here, they have explicitly mentioned the incomes which will be taxed under under the head of other sources. Dividend, winnings from lottery, then the provident fund, keyman insurance policy. You have some received under the keyman insurance policy. Then interest on securities, income from machinery, plant or furniture belonging to the assessee and let on hire. If the income is not chargeable under PGBP, then it will be charged here. The most important philosophical change under this head is the explicit restriction on the misuse of residual classification. The Income Tax Act 2025 classifies that the income should be taxed under income from other sources only when its nature clearly belongs to this head, and not merely because classification under any other head is complex or inconvenient. This reflects the broader legislation intent of the new act, which emphasizes on the correct classification over the convenience. This is the rates that you were talking about. So, as we all know, we have heard that up to 12 lakh rupees, people are the income is non-taxable. But we don't know that it is taxable up to, it will not be taxable up to only 4 lakh rupees. And because it will not be, the 12 lakh exemption is only because of rebate of 60,000, which says like a 4 lakh to 8 lakh, which into 5% is 20,000. And the 8 lakh to 12 lakh, 4 lakh into 10,000 is 40,000, which sums up to 60. So that because of that rebate, your income up to 12 lakh is non-taxable. The new tax rate slabs are uniformly applicable to all the categories of taxpayers, irrespective of age. Previously, we had up to 60 years, the different slab, then 60 to 80 were different. This This is the uniform slab rate applicable for all the age groups.
The slab rates for 1961 have also been changed to 4 lakhs now. So these are the, I think, the old rates
This
which
was
were
the
the old
previous.
for March 25. And the rates, the new rates, the old provision was section 115B AC, and now the new section is 1202. So in that section, they have prescribed these rates. And if Shravani, if you can just show them the act also, and you can show them how the schedules have been uh, put in the entire act. Maybe they can get a feel that you can just show them the act that how it is done. So this is how section 202 has been done. Okay. This is how section 202. This is the section 202. If you can see over here again, as I had mentioned that they have put in a lot of, taken out a lot of provisions and put it in table. This is another example of tables. And now let us see this. This is very interesting that how do we read the new Income Tax Act 2025? If you see this, for the purposes of subsection 1, the total income of the assessee shall be computed as under. So now you were aware that in the old Act of 1961, you had various deductions, such as ETC was there, ATD was there, and all those were completely removed in the new regime, except few, but a lot of them have been removed. So now, how they have put in the new Act, they have said that without any exemption or deduction under Schedule 3. Now, all those exemptions or deductions which were available earlier, now they have been put in schedules. So now these schedules, if you go up again into the index over here, after the sections, lots of sections are there. After the sections are over, how do we have over here? Just right? Okay. So after the section, there are schedules. See, schedule 1, schedule 2, schedule 3. Now it mentioned that in order to compute under section 202, the following clauses under the schedule 3 will not be there, which will be 3, 4, 5. So what are 3, 4, 5? These are 3, 4, 5, 6, 7, 8. Okay. That's how basically the entire act has been come down with.
So this is all again the rate slab rate. The rebate under section 155, which was earlier 87A, is now defined in section 155, which says that up to 12 lakh rupees there will be a rebate of 60,000 rupees. And this is as per the old act, but the amended acts finance act has not been given. Then surcharge rates up to 50 lakh there will be 0%, 50 to 1 lakh there will be 10%, 1 to 2 crores there will be 15%, and 2 crores to 5 crores there will be 25, and after 25 crores there will be 25%, but in the old regime it will be under 37%. In the new regime, the deductions, the slab rate is very flexible to the salaried person. So it opts for the new regime, but you won't get any deductions in the new regime. Whereas in the old regime, the slab rate is not very nice, and thus they are given more deductions to be allowable. Then I'll talk about the TDS provisions. TDS is not a new concept for us. In fact, it has always been most of the effective tools for tax collection and compliance monitoring. However, under the earlier Income Tax Act, the structure of the TDS provisions had become highly fragmented and complex, leading to confusion, compliance burden, frequent interpretational disputes. The new act addresses this issue in a very systematic manner. So previously, the TDS provisions were given in section like 192 was for salaries, then 194 there was the 194A was interest, 194C was for contractors, 194J was for professionals. In the new hack, they have removed everything. They have given one consolidated section 393 for all the other payments, and section 392 for salaries. And they have also given the section in a tabular format to make it more understandable. So this is a section for TDS on salaries. They have given a separate section for salary, which is 392, and all other TDS sections are given under this table under section 393. So they have given commission, every other payment. I'll just say a few things on the TCS provisions. No TCS will on certain education related remittances. Remittance for education financed through a loan for a financial institute are exempt from TCS altogether. Then there is a removal of TCS on sale of goods. TCS obligation on sale of goods exceeding 50 lakh in a year has been removed. They have also removed the higher TCS for the non-filers. This is a new concept. This is not a new concept, but it has been explicitly introduced in the new act. The virtual digital assets. It is given in subsection 2, clause 47A. Sorry, it was defined in 1961 Act in section 2 sub 47A. There is also a new concept of search and seizure powers. So in this, um, they can get your digital records as well for the assessments. Section 247 is a provision that deals with the search and seizure powers under the 2025 Act. It broadly updates the older search and seizure authority. Previously, it was in Section 132 to explicitly include the electronic records and the digital data. The section allows authorized officers during a lawful search operation to gain access to the computer systems or to virtual digital space by overriding access codes or security if those in control fail to operate. Virtual digital space is defined as it includes the digital platforms such as emails, social media accounts, cloud storage, online banking, investment accounts, similar digital environments online trading accounts, digital ledgers, and wallets. Authorities can inspect the electronic records or override the passwords only during a search initiated on the basis of reason to believe that there is an undisclosed income, asset, or other taxable property. Next, I'm going to say about Section 536, which is transitional provision.
Okay. So for any new act to change from the old act to new act, there has to be some kind of a transition because not everything ends in that year. You might have a loss which has to be carried forward. There might be a, scrutiny that is going on, or there might be many years for which reassessment proceedings still can be open. We have a lot of loss to be carried forward. So all such things requires transitional provisions. So Section 536 uh, provides us with such provisions. So basically, if we go through them, it is what it is saying is that now let's say there is a for all the tax years for which the old act was applicable. So till March 2026, all the scrutiny proceedings, all the um, provisions with respect to assessment to 148, 143, 242.1, all the old act only will be applicable to them, not the new act. The old act and the old period of limitation, everything will be applicable. The loss brought forward will be allowed to be carried forward in the next year. Then the old act is to apply. As I said, the old act is to be applied prior to his repeal. The repeal is on 31st of March. Okay. The losses can be carried forward and can be allowed in the new act. So basically, these are all the transitional provisions. So it's like it's helping the assessees to transition into the new act. And there will be a lot more queries, not only this, but there will be. But so this budget, which is coming in next couple of days, we're expecting a lot of changes to be coming up. Rules will also are expected. So we are expecting a lot of changes, and maybe in 2025 also there might be a lot of changes. So let's see. And still, again, the 1961 Act is not yet over. So until 31st of December 2026, to file the last return. The last return. Till that time, you have to still refer 1961. Post 1st of January, maybe it is done. So with that, thank you so much. And thank you for everyone for your patient hearing.
So go ahead with the question and answer. If any guys any doubts, we can ask to the panel. You guys can also ask the question if you have.
We had one question that, ma'am, will the judgment proviso cash loss of income tax act will be
Yes.
applicable in Tibetan too?
Yes, yes. So I think in 536 was there. If- At any judgment which has come in for the old act, the new relevant section, it will the same judgment will be applicable. Yeah, it's natural. Or else it's like a whole new slate.
Yeah.
Can't start with that.
Guys, any doubts over here? Okay. So till now we couldn't get any queries and questions. So moving ahead. Okay, I Sitashik on behalf of Bombay Chartered Accountant Society student committee. I extend my heartfelt gratitude to each one of you being a part of today's insightful session on LND Bootcamp on New Income Tax 2025. A sincere thanks to our esteemed speaker, Ms. Shravani, and group mentor C. Aditya Pradhan for sharing their valuable insight and experience, and to the Human Resource Development Committee of BCS for their constant support in making this event a success. To our wonderful audience, thank you for your active participation and enthusiasm throughout the session. Also, thanks to AHDT and company and their article who are attending physically over here. Also, before we conclude the session, we request you all to stay connected with the BCS and join us for our upcoming programs. That is most awaited CA Student Fest, that is Tarang 2K26, going to be held in Feb month. So we are waiting you guys to connect with us. We are putting the WhatsApp link over in a chat. You can connect over there. We look forward to seeing you again to our future initiative. Thank you for and have a wonderful event ahead.